Well, it is here. The June meeting of the Federal Reserve is upon us. Monetary policymakers began their two-day meeting today. And while most do not expect the central bank to announce a move on rates tomorrow, many are expecting the Fed to signal very clearly that a historic rate hike will occur, and maybe soon. And Fed Chair Janet Yellen is going to have to choose her words carefully so as not to surprise investors and jar the market at the same time. Steve Leisman takes a look now at what some of the top money managers, strategists, and economists are expecting.
As the Federal Reserve began a two-day meeting, a new survey showed Wall Street firmly believing the central bank would hike rates this year, just not tomorrow, or next month, or the month after. 92% of respondents to the CNBC Fed survey see a hike coming in 2015, but not until, on average, September. Even when the Fed starts hiking, the 39 respondents, including economists, fund managers, and analysts, see the Fed increasing short-term interest rates only modestly in the next several years.
I think they're going to tell us, start to hint, it's going to be in September. It's going to be a very small increase. We're going to skip a bunch of meetings potentially between hikes, and this is a multi-year process.
That means the Fed funds rate and rates in the broader economy should rise. In the next 18 months, the survey suggests the 10-year yield will increase to about 3.25%. But stocks are seen faring relatively well, rising almost 10% over the period. The reason? A lot of folks on Wall Street think the market has already priced in Fed rate hikes, so the actual rise in rates, once the Fed does it, not expected to be much of a big deal.
Typically, the market does dip almost every year, and especially around Fed hikes. But corrections usually don't occur when inflation's low and economic prospects are still pretty encouraging. So, look, I do think we're going to get turbulence. I do think it's likely to be a dip to buy.
The challenge for the U.S. economy is the dollar. Higher rates usually cause more flows into dollar-based assets and strengthen the greenback. A stronger dollar can then hurt exports. And many economists worry not so much about the effects of higher interest rates from the Fed, but about the effect of a stronger dollar from those higher interest rates. For Nightly Business Report, I'm Steve Leisman.